The Ferrari call has just ended, and shares are down about 2.5, bouncing between 2.5 and down 3% right now. In this video, we're going to talk about some of the takeaways that we got from the earnings call and our thoughts on that share valuation. So right off the bat, you can grab the presentation from the Ferrari Investor Relations page, and there's a number of details in here. They don't give the full income statement, but they give pretty much everything you need to update the earnings model. We have updated our Ferrari earnings model here to include the March quarter results and the new details that management provided for guidance. If you'd like to download our model, it's available for free on our website, gutenbergresearch.com. Click on the Models tab, scroll down to Ferrari, and just click this icon to download. So there's a couple of key takeaways here on this earnings call. There's a lot of things, a lot of updates that management gave us. First of all, there's the CEO transition, which might be causing a little bit of fluctuation in the share price just as a result of some uncertainty about the new management structure. Management talked about the GTC4 and the distribution will be starting in the third quarter of 2016, which is important. We've changed the shipment details or shipment expectations in the fourth quarter, just assuming that that's where the majority of the change will take place. They talked a little bit about some of the other revenue items. So they talked about a Ferrari theme park that they'd be opening in China. At this point, we really don't have a whole lot of earnings contribution coming from that other category, but it's just kind of something to keep an eye on at this point. Management also talked about the spin-off of the financial service business and the fact that there's still some details that they need to work through in the North America segment. And there is an important point here on the guidance. So if you scroll down to that slide, you can see that they revised all of their details slightly upwards. So shipments, they had originally guided to approximately 7,900 units for the full year 2016. Now they're saying greater than 7,900 units. They tweaked the revenue up a little bit. They tweaked the EBITDA up a little bit. But if you watched our video yesterday, you'll know that in order to get back to the consensus EPS estimate, we actually had an adjusted EBITDA of $810 million. So even though this was adjusted upwards a little, that was probably implied by the price prior to this release anyhow. But you might be saying, okay, if management revised all their metrics, why are shares down? And we think that part of that is going to come down to the tax rate. So we're going to kind of talk about that a little bit. Basically, management did say we saw a lower tax rate in the first quarter. So we were originally modeling a tax rate of 33.5% for the full year of 2016. And the actual effective tax rate for the first quarter came in at 30.4%, so well below our estimate. And then management did make a comment in the question and answer section today that said they expect the full year 2016 tax rate to come in at 30.4%. So that's key, because remember, at our 33.5% tax rate, that would get us to the EPS estimate, the consensus estimate for the full year of 2016 before today's release. So we think that's going to be a bit of a benefit in most of the analysts' models. The other item that they mentioned in the question and answer section is the SG&A rate. So SG&A as a percentage of total revenue, just implied based on the slides that they gave in their presentation, would be about 10% of total revenue. And that's a little bit lower, and that's just due to the schedule of races. So they expect that to be a little bit higher for the rest of the year, but they did say that it was not going to be greater than 11%. So we're going to talk a little bit about what we did in our model for that item. And then the one thing that we just want to mention is management did say that they're going to enter this share repurchase program. And the idea behind that is when they announced the Ferrari spinoff, shares had declined to some extent, and management said that if they had a repurchase program in place, they would have picked up shares at that lower price. So we think this is important because it shows that if shares do start to decline the way we saw a few months ago, management will now have a bit of a backstop because they'll be purchasing shares in the open market. So that's a key development, we think, to take away from today's earnings call. So now let's go through our earnings model. So I'm going to scroll down to the shipment details because there were some pretty important developments here. So first off, in terms of total shipments, this quarter was actually much better than what we had originally expected in our model. So we were modeling 1,665 units shipped in the March quarter, and they actually came out at 1,882 units. But the problem is when we calculate the average revenue per shipment, we were modeling something around 280,000 per car, and the final results were about 255,000. In addition, the total guidance for the shipments for the rest of the year didn't really change that much because they just said it would be greater than 7,900. So we think that that's partially the reason between the lower average selling price and the lower shipment results or lower shipment guidance, despite the better than expected results in the March quarter. That's probably a good reason for the shares to be under some pressure at this point. Despite that fact, we would mention that during the question and answer section, management did point out that the guidance that they're given is actually on the conservative side. So we really should, just based on those comments that they made, we should expect them to beat that 7,900 units pretty easily. So you can see in this model for the full year of 2016, we have set the rest of the year to come back to about 8,000 units shipped. So that's 100 units greater than the 7,900 that management gave. And they gave guidance that it would be greater than 7,900. We just don't know how much greater than 7,900. But at the same time, we had to bring our average selling price down because our average for the March quarter was much lower than what we're modeling before today's release. So what we did, you can see this very exact dollar amount here. So all we did is we said that management guided total revenue to 3,000. We left our engine and sponsorship and other revenue growth rates constant for the next 3 quarters. And then we just solved for the average selling price per shipment to get us back to management's total guidance of 3 billion euro. So when we did that, the average selling price came out to 268,000 approximately. So we know that there's going to be some variability from one quarter to the next based on changes in currency. But when we look at the average selling price over the last year, you can see that 268,000 per vehicle is probably about right. And you also have to consider the fact that there were probably more Ferrari units shipped in the March quarter than we'll see at this point. And, you know, there are some higher price cars that'll be shipping later in this year, but that should sort of hopefully replace some of those Ferrari units. And then again, like management mentioned, the GTC4 shipments will start in the third quarter of 2016, but we'd likely see the majority of that in the fourth quarter. And there's usually a bit of a decline in shipments in the September quarter. You can look back through history to see that. So we think that this decrease of 5% and then this increase in the last quarter of the year is probably what we can expect to see. Now from there we can move down to the SG&A section. So that's the only other piece where we got additional details. Like we said, the SG&A as a percentage of total revenue came down this quarter to about 10%, but management expects it to be 11% for the full year of 2016. So we simply solved for the SG&A as a percentage of ratio for each one of the next quarters, which would result in 11% for the full year. So overall, that is, let's see, prior to this release, we were modeling about 11.8% for each quarter here. So this is slightly lower than what we had expected. And then when we do that, we get back to an adjusted EBITDA, leaving the other items constant from our model yesterday, of 800 million euro. And recall that management gave guidance today that the total adjusted EBITDA would be greater than or equal to 800 million. So that's just simply getting back to what management's results were. And that's including the lower than expected depreciation and amortization expense. So right now we're just taking an average of the last 2 quarters. And since the March quarter was below our expectations, the next couple of quarters will also be a little bit lower than we had modeled yesterday. So other than that, the net cash position improved a little bit, which is helping the share valuation slightly. But overall, it could just be that the shares are down because the shipment guidance wasn't increased all that significantly despite a really strong first quarter. That could have something to do with it. But if you look at the share valuation over the last 3 months, shares are trading at about 28 times the next 12-month consensus EPS in USD prior to this release on an ex-cash basis. But the average for the last 3 months is only 25 times. So if you change this to 25 times, then you'll see that the valuation gets much closer to what we're seeing now. So there could be a little bit of repricing going on, just given the number of announcements and the lower ASP and the lower shipment guidance for the rest of the year. But overall, when you change just that tax rate alone, that's going to have a significant impact on overall earnings for the year. So we think that once all the analysts have updated their models, if they include that slightly lower tax rate, that could be one area of benefit to earnings, which the market is maybe not fully repricing in at this point. Be sure to check back in a few days after all the analysts have submitted their new models. We'll recalibrate this model to meet the consensus estimates. And if you'd like to download this model and plug in some of your own assumptions, you can stick to the blue cells, change the shipment details for the full year 2016, change the average selling price, change really any of these different metrics that we are showing in these blue cells. And right away you can see what the impact is on earnings per share and share valuation. And you can even repost your updated model with your own assumptions to our contributor page. And if you write a little blog post, you can then share that with your friends and share your estimates on Estimize. And if you're interested in financial modeling, be sure to subscribe to our YouTube channel. Thanks for watching, and good luck with the rest of earnings season.